Okay, so welcome to lesson 6 of learning day trading with Tony. And I, of course, am Tony. uh, so today we're going to go over intraday trading strategies, the strategies that I'm using every single day to generate profits. In the last lesson, we were talking about some of the patterns that I like to look for. And what I would like to say is that um, the patterns themselves, um, they aren't really a trading strategy. They're just part of a setup. So actual strategies, they require a little bit more depth than just okay, this is the pattern we trade. We need to know the time of day that we trade it and our percentage success, that sort of thing, right? So we'll get started with this. Just one of my favorite one of my favorite trading strategies. If you've got any questions, feel free to drop them in an email and I'll go over them. I'll respond to them a little bit later. So the first strategy I'm going to go over is the gap and go strategy. This for me is my bread and butter. It's where I make the majority of my profits. I trade gappers, so when I'm trading gappers, I'm going to apply the same patterns that we talked about in the last lesson, the bull flags, the flat top breakouts. But the gap and go strategy for me is just it's a trading strategy. I look for a big percentage gains right out of the gates. So when I'm looking for a gap and go, what is it that I'm actually looking for? I'm looking for the stocks pre-market that have the biggest percentage gap and the highest pre-market volume. That's what I need for a good gapper. Okay, so that's a good gap candidate. It needs to be gapping up at least 14%, 15%, and I prefer at least 100,000 shares of pre-market volume at the very least. Okay. Now, this strategy is really very simple. If we don't have any gappers, then we're not going to be trading this strategy. So, occasionally, with quieter markets, you don't have them. You don't have any really good gappers. I mean, today, for example, I was watching the markets, and the two top gappers were acquisitions. So the thing is, with when an acquisition is announced, very often it will gap up to the purchase price, and then it's just going to stay there. You get maybe a small range of a couple of cents either way, but it's you can't trade those kind of stocks. So we want to make the best trades. We're looking for the best setups, and if we don't find them in the pre-market, and we're just not going to trade the gap and go strategy. We need those pre-market gappers for the gap and go strategy to be successful. So what I would say about this strategy is it does tend to be a little bit seasonal. Where, for example, when we're in earnings season, we're going to have a lot more gappers because we're going to get a lot more stocks with pre-market news or after hours news. So we tend to have a lot more gappers during earnings season. And sometimes we just get into a more volatile market where stocks are gapping up more. And other times it's a little less so. So this strategy might work really, really well for a few weeks, and then it slows down. During the slowdown, we'll trade one of the other strategies a little bit more. Okay. So the checklist for gap and go strategy. Here we go. The checklist for gap and go strategy is we scan for all the gappers, more than 14%. Okay, so the first thing I do is I look for the movers, and then I hunt for the catalyst for that gap, I look into Bazinga. I give a click on the ticker. It opens up the ticker. I can actually then look at the news and find out what the catalyst is for why that particular stock is gapping up. Why is there a lot of pre-market volume? What is the news? So it could be earnings, right? It could be earnings. It could be PR. It could be if it's a pharmaceutical stock, for example. It could be some FDA approval. If it's clinical trials, it could be news on the clinical trials. I just want to know what the catalyst actually is. Now, we talked about fundamental analysis a little bit in a previous lesson, and this is an area where I'm not necessarily going to try and break apart the catalyst, find out is it something that I'm really excited about. I don't really need to understand all the details of the catalyst. Just knowing that there's a catalyst in play that's driving the stock higher for me is really important. Now, there are some catalysts that are going to be better than others. You know, an activist investor taking a stake, for example, when we find out something like that in the middle of the day, a stock will often surge up very quickly. It's basically a news play, but when it happens overnight, the stock may gap up, but it doesn't always squeeze right at the open. And that could be partly because activist investors a lot of the times are taking stakes in larger cap companies, the bigger companies, as opposed to smaller cap, low floats. So I prefer to have a lower float watch list. I prefer to trade stocks that have lower floats. One of the things that's not, I don't think it's on this checklist, but you want to check the float, all right? So the float is the number of tradable shares outstanding. Okay, the number of shares outstanding to trade, and we're going to check the float, and I'm going to look for ideally, I want to be looking for under 100 million shares, but if I'm being honest, the smaller the float, the better, because we're going to get more volatility. So I would actually even prefer under 30 million. A low float stock means that it's a stock that potentially can make huge moves. Okay, so when I've got a stock mapped out on my watch list, um, what is the information that I'm going to have? I'm going to know how much it's gapped up. I'm going to know the pre-market volume. I'm going to know the float. I'm going to know the pre-market high and the pre-market low. And also, I'm looking. So the pre-market high for a gap, just going back a little bit. The pre-market high for a gapper that I'm going to use is the area of resistance, and I'm usually going to buy when that pre-market high breaks. So the break of the pre-market high is what I'm looking for at the open for that. We're talking about the gappers. When we get to the go piece, I'm looking for the pre-market highs. It breaks the pre-market high. That's what I'm looking for, and that's going to be my trigger to enter the trade. So that means on these charts, when the market opens at 9:30 a.m. market time, I'm going to be still looking at all the pre-market price action. I'm not going to discount the pre-market price action just because we move into the regular market. I'm going to have pre-market data turned on, and it's really important because there are charts and patterns that form pre-market, and that can be the basis of our trade at 9:31, for example. I've had days previously where I take a trade at 9:33, 9:34, and I'm in 3 minutes with $1,100 profit. So if I didn't have any pre-market data, I wouldn't be able to take that trade because I wouldn't have seen the flag that was already forming. right? So it's important that you take into consideration the pre-market information rather than uh, just the information from the bell. Now, here's the thing: the stock, it pops up, it makes a quick move. Um, it, the stock, it'll pop up, and it'll make a quick move, and then it's if I didn't have the pre-market data, I wouldn't be able to see that action and the patterns forming. So once it's popped up, it makes that quick move right out of the gates based on the break of that pre-market flag, that pre-market pattern. We get the breakout, and we can get profit on it. And then traders that don't have the pre-market information in front of them, they're just going to see that stock quickly spike up. They'll see it pull back, and they're going to buy the first pullback. So when they're buying the first pullback, we're already in the profit zone. So if we want to go ahead and add more shares, either add back because we sold the whole thing, or we double our size, we can and get even heavier. Um, because we're already in the profit zone, that gives us that little bit of a cushion. Okay. So that's why I like to get in right at the open with these good setups. And then also we can buy the first pullback. So right at 9:30, I've got my orders prepared. I'm on the way my platform works is I can set stop buy orders as well as stop loss orders. So I can actually set stop orders as the market opens. They don't work pre-market, but as the market opens, I can set stop buy orders once it reaches a certain level. So I can put in the share size, the price, the route, all that stuff, and all I have to do then is wait for it to hit that level. So I'll prefer these orders. I'll have my level 2 window open, and these orders will be ready. Okay. So my top 3 or 4 gappers, I'm potentially already going to have orders ready to go. And when the market opens, 2 of them might start selling off. They're not going to be the ones in play, and then the other 2 might start going. I'll watch the volume, whichever one has the most volume, and I know that there's more people interested in that one. That's the one I'm going to jump in on. Okay. So now, when we're doing a gap and go, when we're doing gap and go trading, just move the next slide. What will sometimes happen is the gap and go red to we'll get this red to green. The gap rate will go red first and then it'll go green. Okay, so red to green, this is a sub strategy of the gap and go strategy. And getting red to green by itself is a strategy that traders use. But when we apply it to gappers in the gap and go strategy, it's even stronger. Okay, so what is a red to green move? Well, a red to green move is when a stock goes from being red on the day to green on the day. So it breaks over the open price, the price it opened at. It opens trades below that, and then when it comes up and surges through the open, a lot of times it has a very powerful move. Anyone that decides to short the stock right at the open is going to cover. As soon as it goes green, that's their exit point, which adds to the buying momentum, and then it could potentially be our entry point. So traders that want to be in on the long side, they're going to wait for it to go green to jump in. So you have that combination of both shorts covering and longs jumping in right at that red to green moment, and that's when you can get a very quick move. The volume is increased. Right, so the red to green move on a gapper can be a really good entry. If we're not able to buy, say, for instance, the pre-market flag break, right? If the pre-market flag, if it dips down right at the open, then obviously we weren't able to buy it. So the next setup is going to be the red to green move. It's very common to see a stock that gaps up, sells off for a few candles, and then surges through the open. We'll see that pattern a lot, and I'll show that to you here. Okay, we see this happen a lot. Um, here's a stock doing a red to green move. So we have the gap up, and then we get the the sell off, bit of a downwards consolidation in pre-market. You can see this is where the market opens, so you can see that we've got the gap up, bit of a sell off, consolidation, sideways consolidation, and then the pre-market price action is a little bit, it's a bit grey. So the market opens and we go red. So it opens here and we go red. It sold off for two candles and then it ripped up. Okay. We get the volume. If we actually look as well on that red to green move, we get the volume. You can see that coming in here. And as it's selling off, the volume dies. And then we get the volume each start to increase as it goes. But when we break this point here, that's when we get the big volume for this spike here. Okay, so there's some buyers that start to get in low, and then the volume just picks up. Okay, so the gap and go watch list. What we're looking for here is what do we want to put on the watch list? Okay, so I get my gappers. Uh, I create the watch list before the market opens, and my gap and go watch list is I get all my gap and go ideas from my Benzinga scanners. Where do I get them from? Benzinga. Okay. I've talked about Benzinga on my live. You'll see I have one screen dedicated to Benzinga and my Benzinga scanners. And the first one that I have a number four different scanners that have set up normally, how I trade anyway. And the first one is the gappers on the pre-market session, and I changed that to regular session as the bell rings, and it gives me the moves over the overnight, so it tells me the full gap since the closing price on the previous day's trading. So I can show you those at any time. If you want to check out Benzinger, check it out for 14 days for free. I'll give you the link at the end of the lesson, like I do every lesson. But ideally, stop gapping up between kind of 15-20%. That's what I'm looking for. Ideally more, the more the better, but that's what I'm looking for. So 30-40%, if it's a small cap stock that's having a big day, going from $3 gapping up to $5 or $6, I mean, I'll consider those. There's not a point where it's too high. We don't know if a stock could run from being gapping up 100 to 200%, and we've seen it happen, right? So a trade I took a couple of weeks ago, Inspirato, INSPO was the ticker, Inspirato. And I got in it a little bit late. I was trading a different stock at the open, but I got in it a little bit late, and it was gapping up, and it moved up throughout the day. So it didn't just when I got in, it was already 250%. It was already 250% on the previous closing price. It went all the way up to 750%. So we do see that happen. But yet, on the other hand, we've seen stocks gap up 10% and 15%, and then sell off the rest of the day. So we just have to follow the price action. Just because it looks extended doesn't mean it can't keep going, right? So one of the important things is that when we're looking at the pre-market gap, I want to see the price action consolidating. I want to see I want to see it in the top 20 of 20, top 20 of the range. Okay, top 30, 20, top 20, top 30%. Okay, I want to see it in the top half of the range. I don't want to see it low down on the range. Okay, but that's not to say that it can't move upwards as well. But I want to see that consolidation. Ideally, I want to see that the consolidating in that uh, top third of the gap. Okay, best way to describe this is, let's say if a stock gaps up from 50 to $100, then it retraces to 70 $75. That's the 50% mark. Okay, so we've got a $50 gap up. It started at 50, closed at 50 the day before. It's gone to 100. If it then retraces 50%, it's down to the 75%, $75 mark. Okay, so if it comes back into $60, to me, that's just too weak. So I don't like to see that amount of sell off. I want to see it maintaining some of its gains. I want to see it maintaining the majority of its gains. So 60, 70% of its gains. That's what I'm looking for. Okay. So since the pre-market high in that example was $100, where do we buy it? We can't wait till it goes back up to 100 because we're super chasing. So it can be really hard to manage risk on that type of setup. If there's not a really very clear place where we should be as buyers. So a stock for me that's ideal is going to gap up. It's going to consolidate in the top 20, 30% of the range. And what is a pattern? Quick move up, sideways consolidation. It's flagging, a pre-market flag. So then as soon as the market opens, we're going to buy that flag break. Okay, gap and go watch list. As you can see here, um, these are the gappers of the pre-market session. This is what my scanner looks like, what one of my scanners looks like in the morning. I've got it sorted here by percentage gap. As you can see, it's sorted by percentage gap, but you can see the volume. You can also uh, see what the change is. You can see what the average volume is because we're looking for um, high relative volume. So we can look at what the average volume is. We look at the current volume, and if it's higher, then we're getting relative high volume stocks. And we're sorting by the percentage gap. We want relative high volume. Of course, the change is relative as well. So I can see all of this information in this one scanner. Okay, and this is what I use primarily. This is what I will use to form my gap and go watch list. So if I know a stock is gapping up, if I know I look at the top gappers and the biggest percentage gainers, and then I'll check for the pre-market volume. And as I say, relative volume is important because of the times where, like today, we've got the top two gappers. They weren't moving at all, so that because they were acquisition plays. But we can have times where we'll have a stock gapping up, you know, um, 60, let's 60, it's gapping up 60 points on 10,000 shares. And while the stock is gapping up, 20 on a million shares is actually the one we want to be trading. So if it's gapping up 60 on only 10,000 shares, we follow the volume. Volatility is great. You know, you can have a big gap on low volume. Is not what we're looking to trade. We're volume tracers. As day traders, we chase the volume. We follow the crowds. Okay, we want to be trading the same the same. We want to be trading the same stocks that other retail traders are trading and watching. Okay, so really want keep. I'll keep reiterating. Volume is key. Now, all of the stocks that are gapping up, there are days where we may not well. Today was a good example where we didn't really have an ideal setup out of the gates. So, sometimes you don't have a great gapper. You don't have a watch list, and you've got to wait for the setups to arise. You don't have something at 9:31 right to trade right at 9:31. So instead, we know our gap list. Let's watch the gappers, see which one gets the volume, and let's see which one starts to surge. If we're looking for surging stocks. So by then we start sorting these gappers by the ones that have the heaviest volume. We start looking at these gappers based on the other windows that I'm looking at for the surging stocks. Okay, so we're trying to figure out which ones are in play and which ones are start moving, which were under the radar pre-market. So we might have a smaller gapper that didn't have a lot of volume pre-market, but as soon as the market opened, volume pours into it, or other times it's going to be very predictable which one's going to be the heavy volume, and we don't need to take that extra step. Okay, so just on days where the gaps are not as they're not as great, we can look for the surging stocks as well. Okay, so gap and go, choosing the best stocks. So with the gap and go, we always want to choose the best setup, so the best stocks. This is another area where we can mitigate risk, we can manage risk, and it's part of our overall strategy is all about risk management. Okay, so I select the stocks. I first look at the size of the gap, then I look at the catalyst that's causing the gap, and also I look at how familiar I am with the stock. It might be something that I've traded previously. Okay, if it's a name that I'm familiar with, or I know it's a former runner, a stock that in the past has put in really big moves, I'm going to be more attracted to it. So stocks like DWAC, for example, stocks like PUHN. Um, those are stocks that I've traded, and I know that they can be volatile. Okay, um, so just on that basis, uh, stocks that are putting really good big days. When I see the gapping up, I'm going to look first into those because not only do I know they put in big days, I know other retail traders know it as well. So everyone sees that, and they see it's gapping up today, and we're gonna hit this stock as mob-handed, if you will. We're going to hit this stock as a collective. So we all know that this one has the potential to fly when it has big volume. So even though, let's say Bed Bath and Beyond might be gapping up with more volume and a bigger gap, because it's not, you know, a hot stock, it may not get the attention. So this is another area where the longer you've been in the market, the easier it is to recognize that. Now, I'm familiar with the stock. I know the name. I know the sector. I know the story, and I know it's going to be a big mover. Of course, everyone that is talking about it in a chat room, for example, or on social media, they're going to also have the advantage of other people that have traded it before and talking about it and be able to pick up on that. Okay, they'll be able to get that information. Now, in either case, what we want to do is choose the best stock. So if I'm totally unfamiliar with the stock, I'm always going to be a little bit more cautious. Um, some stocks trade with a big spread. They're very choppy, and other stocks are very clean and easy to trade. So until we know the personality of the stock, it's better to go a little lighter. And if I'm going to take a 10,000 share position, I want to feel confident that this stock is not going to tank 40 cents in my face, right? Now, if I already know the stock, then I'll feel good about that. But something that I don't know that stock, and I don't know that stock has the potential to drop 40 cents. So I already know it's you know if I know it's going to drop, I can be more cautious. If I don't know it at all, I still need to be cautious. So that's something that you know. Uh, if you're doing your pre-market analysis, you're actually looking at other days where it may have ran. So that's something else that we can actually look at. So when you're looking at the chart, if you're looking at your daily chart, if you're looking at other days you can mark out the pre-market highs. Of course, you're going to be doing that, but sometimes there'll be pre-market consolidation. So say a stock gaps up to $100, it pulls back to 75, and then it's consolidating under, let's say, $90. So it's going between 75 and $90. We can recognize in that example the pre-market high is $100. That's the level that's really interesting. But we're consolidating just under 90. So the traders are respecting $90 as an area of resistance. So when $90 breaks, we could take a position there with the first target of seeing $100. So we could potentially get up to 100. If it's still going strong, we can hold our position, maybe even add to it, and we have a good average. Okay, so I'll look at areas of consolidation pre-market, even if they are, well below the pre-market high. Okay, so in terms of how to trade these, right at the bell, 9:30. I have my orders ready to go. They're already, ready set in there. I've got my hot buttons. If I need to, I can just enter in at a position. I know how many shares I'm going to be taking. I know I've got my hotkeys set, so I know what price I'm going to be taking. All I have to do is press the buy button. Okay. Or depending on which order type I'm using, I'd use my hotkeys. A lot of the times, my gap and go strategy, these trades are going to be as short as 1 to 3 minutes, and as long they can be as long as 15 to 20 minutes if it's a very strong stock and we get good action. Okay, what I typically do is I jump in and then I get out and then jump back in and then I get out and then I get in, and all of the breaks to new highs. What I'll be doing is taking profits at regular intervals, and I get out when I first have profit and I want to start scaling out, and secondly when I start to see some sellers come in. So the gap and go for me is it's over 70% successful, but it's because I take profits quickly. So that's really, really important. You take profits when you have them. That's what works for me. So if I'm up 20 cents, I'm going to start taking a little bit of profit. Sometimes when we've had trades that gap up, we'll be up 25, 30 cents, and then they'll go back down to break even. And we stop out. And then we drop 30, 40 cents. So, a decent winner can turn into a big loser if we're not able to move out quickly. And on the other hand, we've had stocks that gap up and then run. They run 5 points. So we've seen both sides. We just have to be ready for whatever the market's going to give us. Now, there are times when a stock will, and we'll use the same example, uh, gap up to $100. It pulls back, and even though 100 is, the high of day, that's where we'd like to buy it. We say it pulls back to 85, and it doesn't have that level of consolidation at 90. It's just kind of pulling back. Well, as soon as the market opens, what do? Right? We wait for it to hit $100 before we buy it because that's the pre-market high. That's the place we expect to see a squeeze. But that will be really chasing it. So instead, what I do is I wait for the first 1 minute candle to close. Okay, so the market opens, we get that first 1 minute candle, and I mark out the high of that 1 minute candle and the low of that 1 minute candle, and that 1 minute candle is called a 1 minute opening range candle. So that 1 minute opening range, when we break that 1 minute opening range to the top side, I'll buy it. So when we make a new high, a 1 minute candle that makes a new high, I'll buy and I'll have my stop at the low of that 1 minute candle. Okay, so I buy the top of the range and my stop is the low of the range. And again, if I'm up 20 cents on that trade, I'll start I'll start selling a little bit and adjust my stop to break even. I'll try to get myself in the driver's seat as quickly as possible. So the 1 minute opening range breakout, again, like the red to green move, this is just a strategy that can be traded. But we're going to apply it to the gap and go stocks because we know those are the stocks that have the biggest potential to run right out of the gates. Right? You could apply the 1 minute opening range break to any stock you wanted, but these are the stocks that I think it works best on. So 1 minute opening range break, realistically, it's only going to work from 9:30. Usually to 9:35, 9:40. The entire gap and go strategy for me by 10 a.m. it's over. Okay, so the first half an hour of the day, it's where I generate almost all of my profits every single day. I would say 90-95% of my profits come from that first 30 minutes, but maximum 45 minutes to an hour. Okay. Midday trading for me usually is a little bit slower. Afternoon trading is usually a bit slower as well, depending on how my morning was. I may be aggressive with midday in the afternoon and generate more profits, or I may sit tight and go easy, not risk giving back the money I've made in the first half an hour to an hour, which for me, when it's easiest to generate profits, and I've said that many times. Uh, if I look at my statistics, I'm most consistent. Normally, I'm most consistent in that first half an hour of the day. So knowing that about myself, you know, because actually today wasn't a great day for me, and I knew that as well. Um, when's the next big chance for me to have a big winner? When's the next big chance for me to make $1,000? It's going to be tomorrow morning. It's not going to be at 2:30 in the afternoon. It's not going to be 3:30 right before. You know, it's going to be tomorrow morning. I know that because I know the statistics, and I use TraderView to map my statistics, to journal all my trades, and I look at the statistics. I watch on a daily basis how I'm performing versus what my normal performance actually is. So I know the statistics of my trading strategies. It's just a matter of fact, right? It's just that's how I trade, and that's important to know because then when you're thinking about being super aggressive midday, all you have to do is remind yourself that hey, hang on a minute, what are the odds that I'm going to have a big winner at this time of day? And if they're only about 20%, then those odds aren't very good. you should probably wait until tomorrow morning, right? That would be the better time to take that big heavy trade. Now, this is the example of a 1 minute opening range break. So this stop is it's a gap and go, and it gaps up, and we can see we're well off the highs here. So 17 was mapped out as the pre-market high. So we're well off the high, and we've pulled back all the way to just under 13, 12.97. Okay, so how do we really trade this? I mean, this is a really big pullback. It's a really big pullback. $3, $4, $5 actually. It's $4. Um, it's not. I mean, that really it's pulled back quite a bit. It's down to 12 and then back up to 12.97. So as soon as the market opens, um, we buy this at 30. We buy it at 30 here. Why? Because we saw that 13 right here was a small area of resistance. Okay? Pre-market, it had been consolidating at 13. We've seen tap this resistance level multiple times. So that's where we can buy it. So I thought, look, a break over 13 and we can get a quick pop. And guess what? We get that quick pop. So then you sell it. You sell the whole thing. Take some profit. Okay. It pops up to 14.46 and pulls back. So we have two things happening, right? Two things happening at the same time. On one hand, we have a very small bull flag starts to form, and two candles of pullback. So if we look here, bull flag, two candles of pullback. The second thing is that we're going to have is we've got the 1 minute opening range candle. So here's the high of that candle, here's the low of that candle. So two things forming at the same time. So we've got a range from 12.97 to 14.46. Okay? And then that's on that opening 1 minute candle. Now, that's some opening range. And traders are going to use the 10-minute, 15-minute, or even the 30-minute time frames. But for this strategy, I'm just looking at the 1 minute because of how volatile the market is right at the open. So on this, there are two ways you can trade it. One, you can buy the first 1 minute candle that makes a new high. That's trading the bull flag breakout. Okay, so the first 1 minute candle that makes a new high is here. Okay, and that's what I would do. And I bought that green candle with my stop at the low of the previous candle. So buy here with the stop here. Very tight risk, but you've got the bull flag forming. So you buy here, and then you've got the tight risk of the low of the previous 1 minute candle. So my stop was at the bottom of that doji, and I bought as the next green candle made a new high. The second strategy, okay, that will be buying the bull flag, as I say. The second strategy is to buy the 1 minute opening range break, or the flat top breakout, or the breakout to new highs, okay? And that would have been buying at 14.46. So we're looking here. So we buy here, which is the bull flag breakout, and then the next one, the next entry, the next entry point or next trigger is here at 1446. So for me, down here, buying at 1350 was buying a dollar off the high. So once we're up to 1446, I can add more shares with a great average buying. Now, a stock that was consolidating right in this area and didn't have this cup shape, didn't have this U shape, you wouldn't need to buy it on the pullback. There's not much of a pullback, but when you have a bigger pullback, the way you do in this case, so this pullback, this bull flag that formed, if it's consolidating, you don't have to buy the pullback, but here you've got an opportunity to do that. Okay, so sometimes it makes sense to take an entry position down low and set your stop at the low of the pullback, and you've got the 1 minute opening range break, which is right here, and that breaks out and squeezes all the way to $17. So there are traders that were able to make money on the first 1 minute candle, like me, because we're up early and had pre-market charts. So we did our homework, and we see that the consolidation. So we look for the break of that resistance. Then other traders, they've missed that first move, so they get in on the first pullback. So they watch that breakout, that bull flag forming, and then by the time we're buying that full first pullback, we're already in profit. We're green on the day, so we already have a cushion on the name. So we're totally in the driver's seat. So say I'm up for $500 on this trade. Now, if I want to risk 1,000 on this trade, I'm already up 500 on the name, so I can be even more aggressive on the first pullback, which statistically is going to get bought up with a lot of volume, especially on a big gapping up stock like this. That's exactly what happened. Get heavy, we get the breakout, and this becomes a big winning trade. Okay. So you look at this. It's what 9:45 a.m. And this thing goes from 13 to 17. I mean, you can't complain about that kind of move. It's huge. When else in the day do you normally have big moves like this? Right? You have them at the open occasionally. You have them on a stock that's squeezing into the close, and occasionally you have that midday on a stock that picks up momentum because there's breaking news or some type of technical breakout. But most common time of the day to see this type of big price action is in the first half an hour. So that's when we're most aggressive. That makes sense to everyone? So, right. In terms of adding to the winners and not the losers in this particular case, we already have a profit on the name, so we're going to be aggressive. If I lost on that first trade, or if I lose on this first candle, then I have to be even more cautious on the second trade because now I'm in the red, right? I don't have the cushion. Once I have that cushion, I can start being more aggressive. Say I made 1,000 on this first trade on that first candle, the break of the pre-market resistance. And then I want to risk, let's just say I want to risk 1,000 on the second trade. Worst case scenario, I lose the 1,000 and go back to zero on the day. And you call it a day, you made nothing. It's a break even day, you lost nothing because you had a free stab at risking 1,000. Using a 2-to-1 profit ratio, if you're going to risk 1,000, it's to make 2,000. And if you're risking 1,000 here with the potential to make 2,000, and say you made that 2,000, right? You're already up 1,000, and you make another 2,000. you're up 3 grand on the day. So that's how we can turn a really nice gapper into a home run trade. It's just getting on base with that first trade. And then once we've got a little bit of a cushion, taking a swing, sometimes we're going to stop out and break even. We're going to give back, the profit from the first trade. But for me, it's almost always worth the stab to go in for the second trade. And you go in on that second trade more aggressively than you did on the first trade. Right? Now, I say the first and second trade, but really it's the first pullback that gets bought up. Now, the second pullback here is the second pullback. It's the second pullback. So this one's the first pullback gets bought up. It's the second pullback here is the it gets a bit choppier, right? It's not as clean. So if you miss the first pullback, getting in on the second one up there is going to be a little bit risky. So you really want to take the first, right? The second, if it's really clean, a really clean pattern, and if the second pullback is as clean as the first one, um, it's going to get a big surge. It's going to surge up, and three candles, candles pulling back. First candle to make a new high. Okay, we can recognise that. That's a clean pattern. But when we see the type of topping tail doji up here at the top, top and then tail, we see that it's a little bit of a sell off, a pop up. It's a little bit more iffy. Okay. Especially when we made that kind of parabolic squeeze. Buying the top of that type of squeeze is really high risk. Okay, so here's another stock. So on this one, out of the gates, we've got what do we have here? It popped up to 880 and it's consolidating. So you should see this chart and know exactly where I'm a buyer. I'm buying this at 880 for the pre-market flag. Okay, so we're getting the pre-market high here, 880, 880, something like that. That's where as it pops up, we're looking for it to break the pre-market high. Okay, that's our entry point. That's our signal to buy in. We buy the breakout. Okay, the breakout to new highs. I buy this at 880. It spikes up to 1096. You look at that move up to 1096. That's a huge move, right? That's 2 minutes. So it's we buy at 880. 2 minutes later, it's up at 1096. That's over the course of these are 15-minute candles. So this is 45 minutes because these are 15-minute candles. But over two candles, that's still a big move. It's a $2 move. Okay, this is the type of big price action that we see in the morning. Right now, this one, we right now we see this one pop up to 11. We pull back here, consolidate, right? And on this one, we saw what do we have here? We've gone up to 11. It's pulled back, consolidated a little bit. We know that 1096 is the new high there. And then what do we have here? Okay. This is a flag we've got, a flag formation that we've got forming. Okay. On this stock, it's forming at around what time? Forming at noon time. So okay, it's coming back up to these highs. So we've got this flag forming. It's kind of ascending wedge, if you will, and it's forming at around noon time. Okay, but this is a momentum stock with a lot of volume, a lot of interest. So it's going to get bought up. 8 out of 10 times, um, a break of $11 squeezes up to 11.90. This one, it's actually squeezed up to 11.97. Okay, and then it flags there for a minute, a couple of minutes. It consolidates, creates another flag, and then it breaks $12 and squeezes up to 14. Consolidates for another couple of minutes, breaks up to 1673, consolidates again, breaks up to 1910, and we're getting this again and again and again. So we start getting stocks that are squeezing like this. They're kind of it's stir stepping. Okay, step up, sideways, and every one of those steps we wait to buy it up. By this time on these trades, we already have a cushion on the day because we take our first trade right out of the blocks here at 880. So you get your cushion on your day, and then you feel good about taking a second stab, and then you win on that one too, and then you feel good about taking a third stab and a fourth, and so on and so forth. Okay. Now, if you've got a big running stock, um, and you see it running, ouch. Uh, if you're watching, if you get a good running stock, sometimes you want to get in, and you're looking. You might miss it because you're trading other ones. So you see that it's running, and it's maybe it wasn't a pre-market contender. And if it's not a pre-market contender, that's okay. But he starts to run, it hits the surge once, and we're getting to kind of midday here, and then you say, okay, I want to do it. So you start looking at these areas. You're looking for, it's in this range, and you think, okay, I don't have a cushion on the ticker. I don't have a cushion on this particular stock right now. Um, but the smart buyers are probably already out of this. So buying it up kind of around here, you're chasing it way up there. It's extended. It's a much higher risk first trade. Okay, so just be careful. Now you can get things like this with patterns like this forming with short squeezes, for example. So as they take short positions, as we tap that, they might cover those positions as we move up to another level of resistance where shorts have positions, but usually you'll see that from other action when you're mapping out your areas of resistance as well. But this is just it's climbing up, it's climbing the stairs, if you will, and it just doesn't pull back. It pumps, pumps, moves sideways, and you know any time it starts to consolidate, you might get people thinking this is a great place to short, and you can trigger a squeeze there because when it goes past that, they will cover, and that's additional buying action. Okay. Um, and any shorts that then take a further trade at the next consolidation level, they're just going to get destroyed. So they're going to have to cover, and it ends up being very a very nice trade, and utilizing the shorts because they have to cover or go broke. Okay, right. So it's always, in fact, it's good when you're doing your pre-market analysis for your gappers. It's good to check when you're checking the float size, check the short float, and which is the number of it's the number of shares available to borrow, and also check the short interest, so the percentage short interest as well. And you can get that from Benzinga in the same place as you're checking the float size as well, and check that, because if you find it's got high short interest, but and it's got it's got a short float in there as well, you can you might be lucky enough to get on a good short squeeze and ride the momentum up. So doing the research to see what the ratio of short interest is good practice as well for your pre-market gap and go watch list. Okay, uh, if you can get onto a short squeeze, you can get really good action. Okay, um, it's not. I wouldn't say it's a premeditated reason to get into a stock, but it can be worthwhile. Okay, so we've got another chart here. Okay, I want to talk about this one. So let's discuss this one here. What we're doing here is we've got the initial pop up here. Then we see the high is 414. Then it starts to pull back and consolidate. Then we see the $4 resistance, so it gets back up to $4 pre-market, that 398. Comes back down, and then it pops. It's consolidating under $4, and then that consolidation. Um, so we see that the resistance is at $4, and it's the whole dollar level. And I keep saying that the quarter, half, and whole dollar levels are important psychological levels. Certainly in these lower cap stocks, um, they're important levels of resistance and or support, but important levels of resistance. So we're consolidating under that $4. As soon as the market opens, that's where we buy. We buy at $4. Okay, it's an important resistance level. So we buy the $4 break. We break that resistance. We pop up 10 cents. We take our profit. Maybe it's 10, maybe it's 15 cents, 20 cents, whatever it is. We take some profit and we start scaling out. Half of it comes back down. We've got to stop out. Okay. So we're in. We take our up there at in at $4. We take profit at say 410, 412, whatever. We've taken half off. Comes back down. We've already reset the break even on the rest. So we get stopped out. We get stopped out at $4 on the rest of the trade. We're still in profit. Okay, but do we have potential for a red to green move for the second move over $4? So that's first of all, we've got a potential red to green move. But secondly, it's over the highs of kind of 420, right? We have a potential 1 minute opening range breakout. So if we buy it at four, uh, we can even add 420, right? We have a small bull flag, so we have a few setups for me, all tied up into this one. So this one pattern, we've got the red to green opening range breakout on the 1 minute, and we've got a bull flag. So that type of setup can be very strong because you have traders that trade those three different strategies all looking at this chart. And we get the nice red to green move. We get nice resolution here up at the top. Granted, it's not a huge winner, but it's a decent one. It's decent. Okay, next example. Okay, so this is it's Gilead. Yeah, Gilead. It's I've traded this a few times in the past. This has a pre-market high of 96.50. Okay, so it's more of a mid-cap stock than a lower cap stock, but this is a pre-market high of 96.50. Looks like we popped up right before the market opened. Okay, we pull back, and then so pops up right as the market opened. It's pulled back, and then we surge back up. Okay, we make a quick move from in 96.50 thereabouts, 96.50 up to 97.31. So a pretty quick and clean opening range breakout, a gap and go strategy. Okay, and look at the big volume right at the open. Okay, the volume candle here, huge, huge, big volume. Okay, it's right at the open. Now, if you look at almost any chart, you'll see at the open, and you'll the first three or four candles are going to have the most volume. Uh, Usually, they're going to have the most volume of the day. For 80% of the charts, most volume will be in the first 10-15 minutes. So, once I buy the high of the day at the open, what do I add on the dip to the next high? So let's go back to let's go back to this chart here. Just a minute. Okay. Let's go back to this chart here. So let's say I buy here at $4. Okay. Would I add would I add more on the pullback? This kind of little bull flag? The answer is yes. But I will almost always have sold half at the top of the spike. Okay. So whilst I'm buying here at $4, I'm taking off there and then I'm adding back in here. Okay. So I have to take profits. So on that particular one, I may well have sold everything, or sold half on the spike and stopped out on the break even on the rest. So I might have been all out of it and then come back for a second trade. Okay, so that's going to depend on how far it pulls back on that first pullback. In the ideal scenario, it's going to pop up so much on that first move that when it does pull back, it won't even stop me out. So if it doesn't stop me out, then I'll hold half, and then when it does make that move up on the second pullback, I'll double back up. So I'll add back what I've already taken off. And I hope that makes sense. So yeah, I definitely want to add to the winners as much as I can. But I also try to scale it aggressively because it's very frustrating for me to be 20, 30 cents up and then end up having it come back to a flat trade. I would say, yeah, I would say the 20 cent mark is when I'm typically going to take profit on the first spike. I'd love to get 20 cents off every gap and go trade. A lot of times I take, you know, 4 to 8,000 shares depending on the price range. Not obviously on $100 stock. I mean, yeah, because my risk would be a lot higher on a higher cap stock. But on the stock price of say $20 and under, I like to take 10,000 shares. So in any of those trades, 20 cents is anywhere from 600 to $1,000. I'm going to start taking. I'm going to start taking that profit and cashing it in. So 20 cents for me is usually a good target on the first pop. If they squeeze up to 40 cents, I don't cap my winners. I don't have an automatic sell order. I'll just once I see it, popping up. Once I see that I'm in the profit, I'll start throwing out more orders to uh, you know, usually if I, let's say I have 4,000 shares, I might throw out an order to sell 1,000. Okay. Once that sells, I might put an order to sell 500 or maybe another 1,000. Right. I'll start piecing out slowly. So I don't throw it all out there at once. I just start throwing out orders if they start getting filled, and if they do, then I'm going to feel confident if I put orders, if I put out orders and nothing happens, then I might say, well, there's no buyers picking up my orders, so maybe I should sell a little bit, sell a little bit of this just at market price or on the bid, just to lock in the profit because it seems like people aren't buying me. Well, certainly not on the offer at least. So. With the gap and go strategy, I know my ratio percentages of success just by tracking it in TraderView. You can track it in an Excel sheet if you want, but I track it in TraderView and I watch it. Okay, so what what we talked about in the first couple of classes was making sure you track all your trades and that you can look at your data later. Find out what percentage of success you're on with each strategy each time of day, and just track your trades so that you actually can do a bit more of analysis around what's going well for you, that kind of thing. For me, it's really important because it builds that confidence that, look, statistically, you're going to know you're trading 70% on the gap and go strategy. You can feel confident every day putting money into it, right? Whereas if you have a strategy that you look at and you run the stats and you're only, 50% successful, you're going to say, I'm not doing that well at this strategy. Maybe I should go a little easier on it. Maybe I shouldn't be as aggressive as I might want to be. So that's how I know my stats. Like I said, it's very important to track that information. It's going to make you more confident trader. It's going to help you because you know your stats. It's going to help you selecting the right setups, etc., etc. So if you're not already doing it, definitely something that you should do. Like I say, you can do it in an Excel spreadsheet. You can do it in another, trader journal. I think there is actually one called Trader Journal or something like that. I use TraderView. Um, whatever you feel comfortable doing. Okay. Now, here's another gapper. This was um, this was a close up of that first day. We surged right out of the gates um, from 825 here um, to 840, whatever it was. We spike up right at the open to 885, and we pull back a little bit, and then we can get in on that first pullback. Okay, first move back. You draw that. You don't have to draw the trend lines, but it's highlighted here. So you can do that. You can draw the trend line. So we get in on that first pullback for a move back up. Okay, so the first trade right out of the gates gives us the cushion on the pullback, and that's the first pullback. So that's where we want to buy it up. Okay, so we've talked about the gap and go strategy. Now, opening range breakouts. I like the opening range breakout as well. Now, this is basically it's a variation of the gap and go strategy. An opening range breakout is going to be a stock that between the first 5, 10 minutes and 20 minutes of the day breaks out to new highs. So I'm going to focus primarily on the stocks that were gapping up, but as a secondary strategy, I'm going to focus on stocks that were under the radar and just had very strong volume in the first 15 minutes or so. So what we'll do is we'll mark out the high of the high of the first 15 minutes. That's the opening range. And then when we come back to break that high, we want to buy it up and buy that high of daybreak. And we call that an opening range break. Okay, so I'm going to apply this to stocks that are surging up or that are gappers. You know, gappers are my first priority at this time of day. But I trade the gap and go strategy first and foremost. But if we don't have a good gap, then I'm going to go and try and trade an opening range breakout on a strong stock with relative high volume. Okay, you know, I want a stock that's just strong out of the gates. Okay, so opening range typically the first 15 minutes. The first ORB, I think, is the acronym ORB, the opening range breakout. Um, so we look at the high of the first 15-minute candle, and when that breaks, we buy the high. A lot of times this will get bought up and we'll get a little bit of a squeeze. Even if it's only kind of 20, 30 cents, that for us is enough profit. It's enough potential to justify the trade. Okay, so in terms of finding these candidates, we'll be looking at our surging up scanners. Okay, the orb setup, it's a pattern like bull flags or like flat tops. It's a pattern. The only thing that really differentiates it is that it only works right at the open. It's an opening range breakout, so that's a pattern that only works from say 9:30 to 9:45. And buying the break of that first 15-minute candle, so we could do an opening range breakout, I suppose, anytime between 9:45 and 10:30, a stock will be consolidating right under the opening range high, and then we'll buy when it does pop up. Okay, so we've got the gap and go strategy, we've got the opening range breakout strategy. Then we've got the momentum trading strategy. Now, this strategy works really well from 9:30 to 10 a.m., but also it works midday on strong stocks. So, what is the momentum trading strategy? Well, these are going to be trades on stocks that have a ton of volume coming into them. Like I've said sometimes, these will be under the radar stocks that weren't on our watch list. They weren't gappers, but market opens and they surged up with volume. They're on our surging up scanner in the regular session, right? That's telling us that's telling us that the stocks have the most volume right now in the market. Uh, so when I see a stock on the surging up scanner, I'll pull up the chart and then I'll be looking for a pattern. One of the patterns that we want to look for first is a pullback. So that's going to be a bull flag, okay, or possibly a flat top breakout. So I'm going to look to get in these strong stocks on the first pullback. And that's momentum trading. Trading these on the second and third and fourth pullback that can be very risky. So I like to take the first one, possibly the second pullback, and beyond that, I'll only keep trading if it's very strong, and I already have a cushion on the net. Okay, so the momentum trading strategy, these trades, they can be quick, 5 to 15 minutes long. Sometimes they're longer, the faster, but generally they're pretty quick trades. Okay. I'll also apply the momentum trading strategy to a stock in the middle of the day that potentially has breaking news. So middle of the day news comes out, let's say DWAC, and it spikes up 2 points. All right. We get that spike up, and what am I going to do? I'm going to buy the first pullback, right? Because now it's a momentum stock. So buying the first pullback, that pullback is going to be usually in the form of a bull flag. Sometimes, if they're really strong, it'll be a flat top consolidating right underneath the high, and then we buy the new breakout. So the momentum trading strategy, we can trade this all day long. The only criteria is that we need momentum and we need heavy volume in order to trade it. So uh, if there's no volume in the market, then this momentum strategy just won't work because there's no momentum. So there are days when we'll just sit and we'll be say, 1 o'clock until 4 o'clock, we could be trading the momentum strategy if something pops up. But if nothing pops up, then we won't be taking any trades. It's important to remember that our job as day traders is to follow the volume around the market. We chase the crowds. We're always looking for where the volume is. And some days there's not a lot of volume for day trading. And other days there's huge amounts of volume. But either way, we sit tight. We wait for good momentum. We look for the setups and then we apply the momentum trading strategy. Okay, so bull flags, flat top breakouts, those can form on any charts, regardless of volume. Those are just patterns. But we only take those patterns and we make them criteria for our momentum trading strategy. We're combining what we know to be good chart patterns with a strategy where we include volume parameters. Possibly time of the day. We know that lunchtime is slower. Even if there is good volume, and that sort of thing. That's where we create a unified strategy where we utilize the patterns, but we also add some more fundamentals that are really important. Now, end of day squeezes. The end of day squeeze strategy, this is where we look for stocks that from 3 p.m. to 4 p.m., especially from 3:30 to 4 p.m., what's affectionately known as power hour. These stocks are up at least 25% on the day. We're going to look for stocks that ideally 25-30%, but they have a lower flow. A flow of, say, it's under 100 million shares, ideally less. We're going to look for these to be potential end of day squeeze setups. So they're going to need to be consolidating right underneath the highs, and ideally we're going to have a nice flag from the afternoon. So from 2 to 3, we're going to have a nice flag that starts getting bought up right around 3, and then we start getting that squeeze into the close. So that's where we can get a little bit of a short squeeze, a stock that's very strong coming into the close. Anyone that's short, they're going to want to cover it. They don't want to hold overnight. They do not want to be holding this overnight. So a lot of times when a stock squeezes into the close, there's going to be a higher probability it's going to gap up the next day. And anyone that's swing trading and is short, they're not going to want to hold this through that risk. Okay, so they're going to want to cover it on the flip side. But also, when you look at it, anyone that's short and that has a margin call, they may be forced to buy back in at market price, sometimes between 3:50 and 4 p.m. So that can create an additional squeeze right at the end of day. So with end of day squeezes, I always set a tight stop because the worst thing is giving back an entire day's profits at 3:50. So set tight stops, 10-cent stops. Try to get 20 to 40-cent profit targets, and then you've got 2 or even a 4-to-1 profit loss ratio. Okay. I don't trade end of day squeezes that often, if I'm being honest. A couple of times a month, maybe, if that. um, because that's how often we'll have really good ones. But it's just another strategy to add to your tool set. Okay, just another string to add to your bow of strategies that you can have a go at, especially on slower days where you're just trying to find a couple of winners here and there. Okay. Um, Momentum. This is a really good example of just a strong momentum stock. You know, if there was this type of momentum was occurring at the end of day, I would definitely consider it for an end of day squeeze. Okay, but this pattern right here, good momentum. We got the pullback, then we get the break to new highs. So we're watching the high of day. We get the pullback, and then it squeezes. So this would be a good chart for momentum trading strategy. And here's another one. Uh, this is on Zaza. This take the the surge up, pull back. Nice. It's a nice bull flag, uh, and then the break to the upside. Well, we'd find the stock on a surging up scanner, but because there's not much of a gap up pre-market, it's not going to be on the gappers. Okay, so there's only a little bit of teeny pre-market volume too. But when the market opens and it shoots up right at the opening bell, stock's going to have momentum. It's called this is why we call it a momentum stock. Okay, so we apply the bull flag pattern to this setup, and we trade it. We trade it for a profit. Okay, so we look at this out of the gates. We've not seen this. It's under the radar, but then we get the pullback starts to form a bull flag, and then when we get here, the next green candle to make a new high. That's when we get in. Okay, so and when we can ride that up to new highs. And what we can actually look for as well is that, or we can look for the high of day break here. Okay, or the opening range break here. So there's a lot of patterns that are forming here that we can look to get in at, and we can look to buy in it. It's not just that we want to be buying or trading only gappers. The gap and go strategy is my preferred strategy, but that's not the only strategy that we can use. So we want to look at for stocks that have that momentum. We look for these candles, lower candles here off off the bull flag, and then the first candle to make a new high. And then we see down here with the volume, and this is the big thing here, is the volume. We see that the volume surge on that first candle to make a new high, and it continues for the break of for the new high break. Okay. And that surging volume tells you that a lot of other traders are trading that. Right now, counter trend trading strategies. This is a technique that occasionally I will use from after kind of 10:30, 10:30 later in the day. I don't usually use it before 10. What we're doing in counter trend trading is we're trading against the trend of the stock. Okay, so strategies that we've looked at already: the gap and go, the momentum strategy, the end of day squeezes, the opening range breakouts. Those strategies are all based on jumping in strong stocks, right? A stock that's very strong, trying to get in on the first pullback, trying to find a low risk entry to get in on the stock that's squeezing. And those strategies work very, very, very well. That's where I make the majority of my profits. 95, if not more, percent of my profits come from those strategies. However, when we're buying stocks that are strong, a lot of times we'll get quick spikes. We want to take profits into those spikes because they can also pull back very quickly. And a lot of times those stocks that are overextended, when we're buying them, uh, so that means there's a little bit of a higher level of risk, right? So my profit loss ratio on momentum strategies is going to be lower because I take 10 cents if that's all I can get. 20 cents is good. If I get 40 or 50 cents, that's kind of rare. So um, yeah, and that's why I have a lower profit loss ratio on say momentum strategies, but I have a higher percentage of success because it's easy for me to identify the strong stocks, so I'm more accurate. But my wins in general are just a bit smaller. So that strategy is my go-to strategy. But counter trends trading, in contrast, I might have a low percentage of success. So I'm not right as often when I do try to guess the top and short it, or I'll guess the bottom and buy it. But when I am right, my winners are really big. So I have a better profit loss ratio on counter trend trading strategies, but a low percentage of success, if that makes sense. So these two strategies offset each other, but I'm more aggressive on the strategy that I'm right on more often than not. So I'm more aggressive on my momentum strategies because just the process and the reality that I'm right more often gives me more confidence. Even though I have a big winners when I'm trading counter trend trades, the fact that they can go against me, I can get 3, 4 trades and have back-to-back losers. Um, it's a psychological thing, just emotionally. It kind of breaks your confidence a little bit. So I don't go as heavy and have repeated back to back losers, and that for me is not something that happens as often on the momentum stocks. Okay, so when we're talking about counter trend trading, again, let's return to the thought that stocks are like a rubber band. Okay, when they're just loose, sitting flat in your hand, that's going to be the VWAP. That's going to be the volume weighted average price. So the loose sitting in your hand, that's the volume weighted average price. That's the equilibrium point. Okay, that's the balance point for a stock at any given point in the day. When the stocks get super extended, super stretched out, right? The more they get stretched out, the more likelihood at some point they're going to bounce back. They're going to snap back, and sometimes with just tremendous amount of volume and a momentum. Okay, so when we're looking at these reversals, if you will, uh, these reversal trades, we're looking for stocks that I clicked that button and it didn't work. We're looking for stocks that are really extended. The reason this works is because we only trade reversals on stocks that are at extremes. So just like my momentum strategy, where I look for stocks that are trending up, have tons of high relative volume, those stocks are all at extremes in their own way. Reversal candidates are extremes in the sense that they've had 5 to 10 candles in a row. They've made a quick move either to the up or downside. So in the case of top reversals, we're looking for stocks that have made very sharp move up and are getting ready to top out. Now, it's worth noting that the market, in the past few years has been very strong. And so a lot of times when we get these pullbacks on stocks that we might think will be a good candidate for a top reversal, they just get bought up. So we always want to set a very tight stop when we're doing counter trend trading. Okay. One, because the percentage of success is going to be a bit lower, right? So since we know we lose a bit more often, we want to make sure The accuracies are not as good. So we want to make sure that those losses are small. And two, because when a stock starts to bounce and move back up, we just want to be able to get out quickly, and we're going to have more confidence taking these trades when we have only a 10 or 15% stop. Okay, so generally speaking, I focus more on the bottom bounces. I'm a long bias trader, so this is why I focus more on the bottom bounces than the top reversals. Um, that I just prefer it. There's no right or wrong. There's no one better than the other, but I prefer buying to shorting. But top reversals can work well if we have the right setup, so you can check that kind of. If you prefer shorting, then um, you do you, boo boo. And we can look at a few examples as well. So here's one. Uh, this is actually this is a good example of a top reversal. Okay, so this was a really good top reversal. On this one, we had what was it? Two, four, six green candles in a row. And what is the sixth candle? What is the candlestick pattern, or what type of candle is that? It's a doji. Okay. This here is what's known as a doji. Okay. And that means the opening and close are the opening point and the closing point on the candle are almost the same. Okay, we've got a little bit of an up wick and a little bit of a down wick, but the open and close are at the same price, pretty much. This candle is completely outside of this Bollinger Band here. We've got the Bollinger Bands on, but it's outside of the Bollinger Bands. Okay, and these pink bands are Bollinger Bands. So these pink bands are Bollinger Bands. Um, and that doji candle is completely outside, and that's another exhaustion warning that you can tell us. And you can also use the RSI and other indicators when trading these strategies. The indicators are not strategies, but you can use them for confirmation on your strategies. So, but that's another exhaustion warning that tells us that this trend is getting really exhausted. It's getting really stretched out. Okay, so you can short this one with a stop at the high of the day. So we get in here and we short it right at the top of that doji candle. So we short it at the high of the stop. The stop is at the high of day. In this case, it was about a 30-cent stop. Okay, and you start covering as it came back in. So this is then a very smooth trade. Okay, and we can find that this stop using you find that stop using the Benzinga scanners if you want. Uh, and to find out what's reaching the high of day. You've got high of day alerts and things, so you can use your Benzinga scanners to find stocks that will meet this requirement. So what do I look for when I'm doing a reversal trade? The most important thing is 5 to 10 green candles in a row, and if you're getting a doji, when you get if it's the top of the range, if you get a doji, you look to short the doji. Okay, I really like shorting dojis. I really like it when I can get a tight stop, and I like it when the candle is outside the Bollinger Bands. Okay, now bottom bounce. So bottom bounce is this is going to be the same sort of thing except in reverse. So we will go through bottom bounces in a little bit more detail. And just remember, you can apply these to top reversals just in reverse. Okay, so the setup requirements we look for a big extension to the downside. Think of that rubber band analogy again. The band getting stretched out. You want to be able to visualize that this stock has made a very strong move to the downside. We prefer to see higher volume. We want to see that peak of the sell-off is also peaking on volume. So what we're looking for ultimately is a V shape. Okay. Now we'll go back to this example. We'll go back to this example on the top reversal, and this has a V shape. Only it's an upside down V shape, so it's like an N, if you will. It's a quick move up and a quick move down. Okay, and the peak of the V has a very high volume. So in this high volume pattern, as we're ramping up, we expect to have high volume on the first candle that sell off, and then decreasing volume. So we're going to look for the same on the bottom bounces. That quick sell off on high volume, a peak in the volume as we bounce, right? And all these buyers and sellers are coming together at the bounce point. We jump in and then we ride it on the way back up. So we're always looking for that quick V shape. If we don't get that quick bounce, we're going to want to get out as quickly as we can. So the best is they have that heavy sell off, that peak, and selling volume. And I'm going to focus between 10 and 4 p.m. So basically, that's the entire day, right? With the exception of the open. But we can have a stock that's at an intraday extreme, let's say 12:30, and it's going to put in a perfectly tradable bottom bounce. So this is a strategy that we can trade through the lunch break or the lunch hour. We can trade it in a slow afternoon. I know trading hours. The only thing that we have to be careful about is what the overall market is doing. Um, okay, so sometimes I do use the wider market to find reversal setups, um, but in the main, we just concentrate on the stocks that we're looking for. Okay. So yeah, the bottom band. So we can look for if we can set scanners for lows of day. So we're looking for stocks that are hitting new lows. So it can be we can get them on the alerts for there's an alert on Benzinga when we get the signals alerts. We can actually find them that are hitting new lows, either low of session or low of day, or you can set it to uh, 20 12 month 365 day low or whatever, but you can set them on the signals to find them, filter out all the noise. um, but if the market as a whole is hitting new lows, just be wary that you probably get a lot more noise because there'll be a lot of stocks hitting lows. Okay, so just because they're hitting new lows on the signals doesn't mean that they're all good candidates for a bounce. Just be careful. Okay. Um, right. So let's look at the let's look at an example of one of these. Okay, so what I want to talk through here is the bottom. Where do we get in? Where do we get in? Okay, we're looking for entry indicators. We're looking for 1 minute candles to make a new high. So as we're getting that volume on, a doge is usually a good indicator, but as we're getting that volume, we want to be taking like uh, five or six, four, five or six red candles in a row, and then we treat that as we would a bull flag in the momentum strategy. We're then looking for a new 1 minute candle to make a new high, a green candle to make a new high. That's a good entry point. Okay. And we look for that on the 1 minutes. Okay. We also can look for the 5 minute candle to make a new high. Um, and we double that up. So what I tend to do with the 1 minute and the 5 minute charts is I'm looking for trades and setups on the 1 minute, and I want it underpinned by the 5 minute. So what I can then do is if we're getting the bounce on the 1 minute, if I correspond with the 5 minute, I can then add to the position, or I can double up on that position if we get a new high on the 5 minute as well as on the 1 minute. When do we get out? Well, the stop is always the low of day, so you should have a relatively tight stop. And then as you're taking profit, you adjust your stop to the low of the last 5 minute candle as you move into the profit zone. So you take profits, you get a 20 cent bounce. You'll take half off, and then adjust your stop back into kind of the either the low of the previous 5 minute candle, or break even. And you keep selling along the way. The target, ideally on these reversal, the bottom bounce, the target that you want to try and get to in terms of profit is if it's a complete reversal and you get a complete change in trend. So it's a counter trend. And you genuinely have bottomed out, the target will be the volume weighted average price. So that's always the ultimate target for a bottom bounce reversal. And if you get to the VWAP, then you may then look at a different strategy, but that's always the target. Okay, let's look at this particular bottom bounces have the advantage of shorts covering and retail traders jumping in. Absolutely. So that's a very big. Uh, it's a very good point. Is that as shorters are looking to take profit, they're covering at that low of day because they themselves want to maximize the profit. So think of it from the momentum strategies that we've already talked about. What you're taking your profit, you ideally want to take it at the peak. So if you start to see the reversal, you're getting out of your long position to maximize your profits. The shorts are in the exact reverse. So if they're in a short position, they're not going to hold for the reversal. They're going to take profits, which actually adds to the buying pressure, and then you get retail traders jumping in to scalp the bottom bounce. So you get that influx of momentum and influx of volume, and that then increases the buying pressure upwards. So the bottom reversal, that's what causes the bounce. Okay. So let's have a look at some examples. Let's see the let's see the examples. So we've got an example here, and it's a 1 minute versus 5 minute. So here we've got a nice 5 minute bottom bounce, Time Warner, and it's a nice sell-off. 2, 3, 4, 5, 6 red candles to, and then we look for we've got the doji, and then we look for the next candle to make a new high. So we could set our stop uh, here. This is our entry point, 134.33, but we could set our stop at the low of day, or we could just set our stop at 134, which is the low of this candle. Because we're actually getting in to make a new high, we could set the stop and get in with a 20-cent stop, for example. And either it goes or it doesn't. And in this case, it went. Okay, so we've got a really nice bounce. So we would take profits here, and then what we're looking for here is the target. So we got to pop up to our moving averages, and on then we get a quick sell off. Okay, so here on the 1 minute there, and then we get the sell off. Okay, so we'll get to was it 12:45 midday. We get the sell off from around 68 down to 65. And then the first 1 minute candle to make a new high over 65.50, which is here. We get the buyers coming in, and we get that peak in volume. So we've got huge run in volume at the bottom, and then we get we see this the buyers coming in, and it bounces right back up. Okay, another bounce example here, right, is we've got the sell-off. We've got 11 red candles in a row. Then we've got the doji at the bottom. The first candle to make a new high, which is the orange one. First candle to make a new high. This coloured it orange for you, and that's where we buy it. Okay, so we're buying 1084. 1091 is the new high. Is the high of the doji. So the bottom of that. So we're looking. It starts at 1084. The next one makes a new high, 1091. We sell on the move up to 1150. So even on a lower price range, we can still get really nice bottom bounces. Okay, remember this pattern. This is the same thing we would look for a top reversal, right? We would look for 10, 12 green candles, doji at the top, and short that doji. The stop can be the low of day, so 1066, Battle of Hastings. So stop can be low of day, or it can be 10 or 20 cents away, depending on the price. Now, let's have a look at the next one. Cruise. Okay, so we've got the sell-off. Got the sell-off, and all the way down, selling, and then first 1 minute candle to make a new high, and then we get a pop. Okay, this one's not quite as clean because we're on the 1 minute chart. Okay, so it's a 1 minute chart. So this one's not quite as clean, but even though it's still a bit choppy, it's still a good it's still a good bottom bounce. 1 minute charts can be a little bit riskier. You'll see the cleaner setups are on the 5 minutes. Let's have a look at this one. Here's another. Here's another. Okay, on the 1 minute, we sell. We put in a little bounce. We sell, bounce, sell, bounce, sell, bounce. So then we're all of a sudden down at the bottom. So we sell, bounce, sell, bounce, bounce, sell, bounce, sell, little bounce, sell. So then all of a sudden, right at the bottom, we actually start to reverse. Well, by this time you already tried it once, twice, three, four, five times, six times. So this is why instead of using the 1 minute, which can be a lot choppier, that's why on for these reversal strategies, this is why I prefer to use the 5 minute chart. Okay, so unless we have a clean 1 minute, and a clean means we don't have these choppy bounces, we just have a steady sell off. Otherwise, I'm going to focus on the 5 minute chart. Okay, now I think that that's pretty much it for the day. If you have any questions, here's my email address. Just ping me an email. Um, as I say, I document all my trades on TradingView. I get all the scans and alerts and signals from Benzinga. Um, TradingView, a lot of the charts you've seen today, this is what I've been mapping them out on is TradingView. So yeah, the we're going to cover off the stock scanning in the next lesson in a bit more detail. So you see what we're doing with Benzinga, and I'll show you how to create and set up your scanners first thing for pre-market and the likes. Um, there's no amount of scanners, no limit to the amount of scanners you can set up. If you can take more data at any one time, I have my setup, and I'll show you how I do that in the next lesson as well. So in the meantime, thanks for joining me for this lesson. I hope you found it informative, and if you have any feedback, like I said, drop me a line. Thanks a lot.